Hello everyone, and welcome to Accounting Insights with Rula. Today, we'll explore three key financial statements: the income statement, the balance sheet, and the statement of owner's equity. You'll learn how to read and use these reports to understand a company's profitability, financial position, and changes in equity. By the end of this session, you'll clearly understand how these documents work together to provide a complete picture of a business's financial health. Let's get started. Let's begin our discussion on the income statement. A crucial financial report that provides a detailed overview of a company's revenue and expenses, ultimately revealing its net income or loss for a specific period. Also known as the profit and loss statement, operating statement, or statement of operations. It offers important perspectives on the company's operations, the effectiveness of its management, areas that may need improvement, and how it performs relative to competitors in the industry. Imagine the income statement as a funnel, with money flowing through various stages. At the white top, we begin with revenue, the total money coming into the business. As it flows down, expenses are subtracted, like the costs of running the business, such as salaries, rent, and utilities. The funnel narrows as we deduct these expenses, leaving us with the final result at the bottom, either net income profit if revenue exceeds expenses, or net loss if costs are higher. This visual of the funnel helps us see how a company's finances are gradually filtered, allowing us to clearly understand how revenue turns into a final result, whether profit or loss, by the end of a given period. The income statement plays a key role in evaluating a company's performance over a specific period. It answers two critical questions. How well did the company perform during that time, and did the company make a profit or incur a loss? Let's look at the elements that make up the income statement. Revenue is the increase in capital resulting from the sale of goods or the rendering of services by the business. In amount, the revenue is equal to the cash and receivables gained in compensation for the goods sold or services rendered. The second key element is expenses, which represent the decrease in capital caused by the business's revenue-producing operations. In terms of amount, expenses equal the value of goods and services used up or consumed in obtaining revenue. The income statement's outcome can either be net income or net loss. Net income reflects increased capital from profitable operations occurring when revenues exceed expenses for the accounting period. Conversely, net loss represents a decrease in capital occurring when expenses surpass revenues during the period. The two key components that drive net income are revenue and expenses. In essence, net income is calculated by subtracting expenses from revenue, revealing the company's profitability. It's critical to distinguish between cash receipts and revenue, as only revenue contributes to increasing capital. Cash receipts refer to any money received, whether it's from revenue such as sales or other sources like a loan. Revenue, on the other hand, is the income generated from normal business operations, such as the sale of goods or services, which contributes to an increase in capital. Accordingly, borrowing cash from a bank results in a cash receipt, but it does not qualify as revenue or increase the company's capital. Instead, it creates a liability, a loan, that the company must repay in the future. Cash payments and expenses. A cash payment refers to any outflow of cash from the business. It could be for various purposes, such as paying off expenses like utilities or salaries, or settling liabilities like loan repayments. Not all cash payments are considered expenses. Some are used to reduce debts or acquire assets. Expenses are costs incurred in generating revenue, such as purchasing materials, paying salaries, or renting office space. In contrast, a payment to repay a loan is not considered an expense because it doesn't reflect the cost of operating the business. Instead, it reduces a liability, which is the debt the company owes, rather than directly affecting the company's income or capital. Here are the key takeaways. Revenue increases the company's capital because it represents the money the business earns from selling goods or services. On the other hand, expenses decrease capital because they are costs the company pays, reducing its profits. When a company borrows cash from a bank, this doesn't increase capital, it increases liabilities, which is money the company owes. As the company pays back the loan, the liability goes down because the company is reducing what it owes. Let's go through Mr. Alan Bagan's income statement for January 2023. We start at the top with revenue. This is the total amount Mr. Bagan earned for his services during the month. Next, we move down to operating expenses. These are the costs required to run his business. Finally, we calculate the net income, which shows how much Mr. Bagan earned after covering his expenses. Revenue and expense accounts are temporary accounts that track the income earned and costs incurred over a specific period. At the end of the period, their balances are closed and the net difference is transferred to a permanent account, the capital account, which appears in the balance sheet. Accurate timing in recording transactions is essential for reliable financial reporting. The income statement reflects financial performance over a specific period, whether a month, quarter, or year, by accurately timing the recording of revenues and expenses. Under the accrual basis of accounting, companies recognize revenue when it's earned, not necessarily when cash is received, and record expenses when they are incurred, regardless of when they are paid. A key concept related to this is the matching principle, an integral part of accrual accounting. The matching principle ensures that companies report expenses in the same period as the associated revenues. This alignment accurately depicts the company's financial performance by matching related revenues and expenses on the income statement for the same accounting period. Doing so helps show a clear picture of a company's operations during that period, preventing misleading financial results that could arise from recognizing revenue or expenses in the wrong periods. Here's an example. Suppose you own a bakery that offers an annual bonus to employees calculated at 5% of the revenue generated each fiscal year. Although the bonus is earned during the year, it's paid out in January of the following year. In 2023, the bakery's revenue totaled $200,000. According to the 5% policy, employees will receive a $10,000 bonus scheduled for payment in January 2024. Even though the bonus is not paid until the following year, the matching principle requires that expense be recorded on the 2023 income statement as an expense of $10,000. On the 2023 year-end balance sheet, the bonuses payable will be credited with $10,000, reducing capital by the same amount. This adjustment lowers net income while keeping the balance sheet in alignment. In January 2024, when the bonus is paid, there will be no effect on the income statement. Instead, the cash balance on the balance sheet will be credited by $10,000 and the bonuses payable account will be debited by the same amount, maintaining the balance. Following the accrual basis and matching principle, the income statement is crucial for stakeholders to assess the company's profitability and operational efficiency over time. The cash basis of accounting identifies a transaction whenever cash is involved. In this approach, revenues are recorded when cash is received and expenses are recorded when cash is paid out. It's a straightforward method that's easy to understand and often used by small businesses. However, according to GAAP, generally accepted accounting principles, this method is unacceptable for preparing formal financial statements. GAAP requires more comprehensive reporting that reflects the economic reality of transactions, not just when cash is involved. A major disadvantage of the cash basis is that it doesn't work well for businesses with large amounts of inventory, receivables, or payables, as it fails to provide a complete picture of the company's financial health. The second financial statement is the balance sheet. It shows a business entity's assets, liabilities, and owner's equity at a specific time. It also known as Statement of Financial Position or Statement of Financial Condition. By looking at this statement, we can understand what the company owns, what it owes, and the net worth attributable to the owners. The balance sheet items require the net balances at the end of the period, unlike the income statement, which shows totals for the entire period. And here's an important clarification. The balance sheet requires net balances at the end of the period. For example, how much cash is in the account at the end of the period? How much does the company owe as of that date? What remains for the owners at that exact time? While the income statement shows totals for the entire period. For example, the total sales made during the year, the total costs incurred throughout the year. Let's review Mr. Alan Bagan's balance sheet to assess his business's financial health. On January 31st, Mr. Bagan, a lawyer, examined his balance sheet to check his business's finances. On the left side are assets, which are resources expected to bring future economic benefits. These assets include cash, supplies, and equipment. The right side shows liabilities and owner's equity, representing how the business is financed. Liabilities are amounts owed. Owner's equity is the owner's interest in the business. Mr. Bagan started with $5,000. January's net income was $1,100. $300 withdrawn for personal use, resulting in an $800 equity increase. His total equity is now $5,800. Adding liabilities and equity equals $7,300. This total matches the assets. January's net income of $1,100 affects the balance sheet by increasing the owner's equity, showing how profits enhance financial health. The balance sheet can be arranged in either report form or account form. In the report form, assets are listed at the top with liabilities and owner's equity shown below. In the account form, assets are placed on the left side while liabilities and owner's equity are on the right. Both formats are acceptable as long as accurately represent the financial data. Statement of equity. It details the changes in a company's equity starting from the opening balance to the end of period balance. These changes include earned profits, dividends, additional equity contributions, equity withdrawals, net loss, and similar adjustments. It also referred to as a statement of owner's equity or statement of returned earnings. Let's walk through the statement of owner's equity for January 2024. Mr. Alan Bagan's equity began at $5,000. After adding a net income of $1,100 and deducting drawings of $300, the capital increased by $800, ending at $5,800 on January 31st, 2024. I hope you enjoyed our session on financial statements. I appreciate you all for listening. Goodbye.